For the last 10 years, the strategy of making money in Ontario's real estate was simple. Buy a rental property, make sure it cash flows, and let the market do the work. A rising tide lifted all boats. Well, as of January 2026, that ride is over. The aggressive passive appreciation that was driven by low rates and market frenzy demand has concluded. We are now entering an era of what I call structural reinvention. Here is the hard truth. In 2026, you don't find value, you force it. You can't just wait for rates to drop. You have to restructure your debts to ride the wave. You can't just buy a house. You have to reinvent the floor plans to densify the site and add income. We're now moving from a market of easy wins to a market of manufactured wins. The data is showing that the market is splitting into two. The passive real estate investor who is getting squeezed, unfortunately, trapped between higher mortgage payments and capped rental income, and the strategic real estate investor who is adapting and is still earning decent returns. My name is Dalia Barsoum. I'm the founder of Streetwise Mortgages, a multi-award-winning mortgage brokerage and a 2 times recipient of Canada's and Ontario's Mortgage Broker of the Year award. My team and I have spent the last quarter analyzing reports from across the industry, tracking the lending guidelines, construction costs, and the landlord tenancy board timelines to identify arbitrage opportunities for this year. Today, I am going to reveal 5 critical shifts that are defining and shaping the 2026 investment landscape in Ontario. These trends will distinguish the prepared strategic real estate investors from the unprepared speculative real estate investors. That's where the wealth will be made, and that's where the returns will be made. So let's dive into the intelligence. Let's start with trend number 1, and it is likely the one that is keeping you up at night right now: the mortgage renewal cycle. If you have secured a mortgage in 2020 or 2021, you are probably part of the 60% of Canadians hitting the renewal wall this year. You're moving from these historic low rates in the 2% range to a 4 or 4.5 right now. For most of you watching this translates to a 15 to 20% jump in your monthly mortgage payment. So let's pinpoint the risk here. Okay, and I'm gonna give you some tips on how to deal with this. The extra rate is not gonna impact your equity. In fact, many of you have a good chunk of value still in your portfolios. This is going to impact liquidity. It's a liquidity drain because when the rates go up, it increases your holding cost and it puts extra pressure on your cash flow. You may have to tap into your own pocket to cover that shortfall, and that's what puts the pressure on your liquidity and cash reserves. So good news is when it comes to mortgage renewals, guys, the tables have actually turned with the lenders. You now are in a more favorable position to get the best rates out there and the best financing. In previous years, I noticed that the lenders were rigid, but right now they are competing so hard to retain your business because business is slow. You may have actually received an offer from your lender in the mail to sign an early renewal with a quote-unquote discounted rate. But I want you to be aware of some key traps before you sign. 1, that lender cares about their retention targets. They don't care about your financial goals and needs in the short and the long term. The goal is to get you to sign that piece of paper so they can retain your business and ideally stay with them for the long term. Signing that letter will likely secure a great rate for yourself, but it misses the big picture of potentially saving you money or lowering your monthly payments or restructuring your financial house. So before you sign, I want to give you a couple of tips and also want you to reflect on a few things. 1, do you need breathing room? Are you looking to reduce your monthly payment right now or save because you have high debts? Because If the answer is yes, there is an opportunity to stretch the amortization on that mortgage for 30 years. Number two, do you have any expensive lines of credit? Trend number two is about densification. Everyone is talking about Bill 23 and the missing middle, which allow you to add legal units on a residential property like a garden suite, an ADU, or a laneway house without paying for the developmental charges. There are cities that allow you to go up to 6 or 7 units even without paying these charges. But before you rush to build and jump on this new trend, look at the math. In 2026, the cost to build a garden suite, for example, has increased significantly. You as an investor need to choose a path based on your level of experience to be able to tap into this trend. For the experienced operator, if you have in-house trades and tight project management capabilities, you can still achieve a strong yield on these new builds despite the cost, and we call that building out. This means pouring new foundations for garden suites or additions to push the property value significantly higher. But if you're starting out as an investor and you don't have these in-house capabilities and you want to minimize your risk and reduce your cash outlay, I would suggest something called building in, which means staying within the boundaries of the existing walls, converting a basement or splitting a duplex, and creating units without the heavy costs of adding a new structure. But here's a key critical success factor. It's actually financing. Regardless of which path you choose, the type of financing you select to acquire the property, to build, and to exit can hinder or enable your success. I see many real estate investors get into densification and get stuck because they've got the wrong capital structure. They end up with extra cash calls along the way or extra costs that they did not anticipate. At Streetwise, we help investors structure financing for densification effectively. From the money required to acquire a property, to the money required to build it or renovate it, to planning and validating your exit strategy, whether you're looking to refinance and keep the property or sell it. We match, so for you as a real estate investor, match the strategy to your operational strength. Build out if you can control the costs, and build in if you want to manage the risks and reduce the cost. Whether you need flexible construction money from credit unions, low-cost CMHC funding, or strategic private money, we have the full spectrum of money options for densification here at Streetwise. Click on the link in the description to book a densification project review with one of our team members and to plan your capital stack effectively to manage your risk and enable your returns. Whether you need flexible construction financing from a credit union or low-cost CMHC money or strategic private money, we have the full spectrum of money options here at Streetwise. We can help you plan your project end-to-end, understand how the pieces fit together, get you the best type of financing to keep more money in your pocket and to reduce your costs and to enhance your returns. Click on the densification project review link in this video to have a conversation about your project and plan your capital stack with one of our Streetwise mortgage advisors. This third trend is operational, but it has a direct impact on your choice of investment strategy and on your financing. We need to talk about Bill 60, introduced in October 2025, relating to Fighting Delays and Building Faster Act. On paper, this bill is supposed to speed up evictions for non-paying tenants and streamline the landlord and tenant board in Ontario, which is a move in the right direction, and it is important for you as a real estate investor here in Ontario. But the reality is that the lenders do not trust the speed yet. They're actually pricing tenant risk directly into your approval in 4 ways. The first impact is on residential qualification of 1 to 4 units. Let's say you're buying a duplex with low rents today. The lenders will use these lower rents to qualify your deal. They don't care about the new speed that Bill 60 enables. If you do not have a vacant possession in your offer, even though that unit can rent for a higher amount, supported by what the appraiser is saying, the lenders will use the lower rents. And that can translate into you having to put a higher down payment into the deal as a result, depending on how the numbers play out. The next one is related to turnkey apartment buildings or multifamily units, 5 or more units. Let's say you're buying a 5-plex or a 6-plex and the rents today are below where they need to be, but you don't have an immediate plan once you acquire that building to increase the rents. Your plan is to increase the rents as the tenants churn. What does this mean? Well, what it means is that the lender is going to look at today's rent, and typically you're buying the property here, the price reflects its potential, and your net operating income today is below that potential, but the loans that the lenders are going to give you, the commercial loans, are going to be based on the NOI today. And as a result of these lower rents, they're going to give you a smaller loan amount, meaning that you're going to require a higher down payment. So again, the fact that you don't have a definitive plan to turn these units around once closing happens, and you've got a future plan to do so, doesn't mean that the lender is going to lend you money based on that future plan. So you gotta account for that in your projections and for your down payment. The third impact is on apartment buildings that you plan to reposition. Let's say that you're buying a building today where the rents are lower than what you can charge once the tenant leaves. But on the day of closing, you've got a plan on how you're going to increase these rents in the next 6 months or 12 months or 24 months or 36 months. What the lenders are doing is they are accounting for a longer runway for you to actually reposition these units. Gone are the days where you do a cash for keys and you're able to vacate these units and start renovating right away. So the lenders are taking these things into account, which means that they may look for ways on how you're going to be able to support the loan amount in terms of payments every month until you turn these units around. They may suggest you also take a longer term, for example. Although initially you're anticipating to turn the units around in 12 months, they may say, no, you know what, let's do an 18 months or 24 months so that you can account for these extra delays. The third one has to do with renovations and the BRRRR strategy. The fourth impact is on your carrying costs. If you are using private funds to renovate or to do the BRRRR strategy, for example, then the clock starts ticking as soon as you set up these private funds. And if vacating a unit is going to take 8 months instead of 3 months, you are really accruing interest on these expensive loans, and that will eat into your return. So you have to plan for things like that, and you have to plan a buffer, especially if you're taking private money. So when it comes to the Bill 60 trend in 2026, you don't just underwrite the bricks, the numbers. You have to underwrite for the timelines. For residential, if the rents are low, negotiate a vacant possession or have that extra down payment at hand to close the deal. For renovations, build a delay buffer into your private financing budget, okay? So it's important for you as an investor to price these risks into your offer and into your plans, and also you must structure financing to align with these timelines. Trend number 4 is a specific warning if you own or looking to invest in student markets like Waterloo, London, and Windsor, Ontario. With the federal cap on international students fully hitting the market, we are seeing a shift in demand. The volume of students looking for rentals has softened in many of the secondary markets. Obviously, there are exceptions, but overall, that demand has softened. The market is split into two in that space. Tier 1 are the purpose-built modern units that are near the campus, and these are still performing well. And Tier 2 are the converted houses, older rooming houses that are further away from the campus. These ones are seeing higher vacancies. So if you own in these markets, you may want to pivot your tenant profile. Smart investors right now are renovating and rebranding their units to appeal to younger professionals that are in the local workforce, and those include tech workers, salespeople, nurses, and that is keeping their vacancies low. And if they want to appeal to students still, they are renovating their units and enhancing their appeal. So this trend is shifting the demand and is shifting how investors are filling in these vacancies right now. Trend number 5 is the return of the buyer's market. This is the biggest opportunity if you have capital to invest, you have gifted money, you know how to structure creative financing. And for the last 4 years, guys, we complained about the lack of inventory. We had to bid sometimes blindly with no conditions and compete against multiple offers and go for over asking prices. We are finally seeing inventory stack up, and homeowners are listing to avoid the renewal shock. Some investors are listing non-performing strategic assets, and we're seeing a healthy level of inventory. This is the return of the buyer's market. So in 2026, you have the power of the time and conditions on your side. You can insert financing clauses back again to protect your offer. You can demand thorough inspections. You can negotiate better prices. I am seeing deals that are structured using creative financing, and I'm seeing clients pick up quality assets at great prices that are actually cash flowing simply because they are going forward with offers in a slow market right now. So if you are planning to enter the housing market this year and acquire assets, you need a strategic pre-approval that considers the new market reality. Contact us before you put an offer forward. We'll help you connect the money dots and structure financing to enable your success and avoid any costly surprises. Here is the verdict. The opportunities in 2026 are real, but they require planning and precision in executing. It's about internal conversions and managing risk to enhance your returns and yield. It's about strategic structuring of mortgages and money to enhance your savings and to ride the rate cycle. And it's about tapping into that inventory to pick up great deals and negotiate better offers. If you're holding a portfolio and you're asking yourself, is my lender offering me the best financing options and structure? Can I explore other options that will help me get ahead and enhance my cash flow? Is my portfolio protected given where interest rates are headed in 2026 and beyond? If you're asking yourself these questions, you need a strategic financing plan, not a mortgage, not a rate. We are currently offering a 2026 portfolio strategy sessions. My team is taking on a limited number of clients to help plan the financing strategy for 2026. They will take the industry insights and overlay them on your specific properties to help you optimize your portfolio cash flow, identify any financing risks and opportunities, and map out your best moves for the year ahead. Click the link in the description to book your complimentary strategy call with a Streetwise mortgage advisor. And remember, the market rewards the prepared. So let's make sure that you are ready to win this year. Thank you for watching. If you found value in this video, hit the subscribe button. I would appreciate you giving us a thumbs up, share it with someone else to be of service, and watch for our next video. I wish you all the best in 2026 and stay streetwise.